All right, sorry about that. Got cut off. So we are in part 2 of chapter 1 example problems. This company wants us to, or that we want to calculate the amount of net income for 2009. Knowing that total assets were 400,000, total liabilities were 250,000, we know that total liabilities have to equal total liabilities plus owner's equity, which means owner's equity at the end of 2009 must have been 150,000. That's the only way that equation would be in balance. We know that we started the year with 100,000 in owner's equity because the business began with an owner investment of 100,000. That means during the year, owner's equity increased from 100,000 to 150,000 at the end, or an increase of 50,000. We know owner's equity is affected by two things: the amount of net income and the owner drawings. If the owner withdrew $15,000 during 2009, that means income must have been 65,000, because income earned increasing equity of 65,000, owner's drawings decreasing owner's equity of 15,000 means there was a net increase during the year of 50,000 in owner's equity. Thus, net income for 2009 must have been 65,000. Okay, let's take a look at the next year, 2010. Total assets were 460,000 at the end. Total liabilities were 300,000. That means we must have ended 2010 with 160,000. We began the year with 150,000. Last year's ending owner's equity becomes this year's beginning owner's equity. Lily made an additional investment of 50,000 but did not withdraw anything. Over the year, equity increased 10,000. The owner invested 50,000. Because the owner invested 50,000, increasing owner's equity during the year, but overall equity only decreased 10,000. That means that the owner investment was offset by a net loss during the year of 40,000. So overall, there was a loss for 2010 of 40. All right, finally, the last year, 2011, assets at the end were 590. Liabilities were 400. Assets must equal liabilities plus owner's equity. Thus, owner's equity at the end of 2011 must have been 190,000. Lily made an additional investment of 15,000 and had drawings of 30,000. We ended the year with 190. We began the year with 160 because last year's ending becomes this year's beginning. That means overall, we had an increase during the year of 30,000. The owner invested another $15,000 during the year. That means that the increase in owner's equity, part of it was an owner investment of 15,000. The owner withdrew 30,000. That means that net income must have been 45,000 for the year. Because if net income of 45,000 was earned, 30,000 of it was taken out by the owner. The owner then invested 15,000. That would account for the $30,000 increase in owner's equity for the year, leaving us with net income of 45,000 for 2011. All right, let's move on to one last problem to work through together. This problem is Jenny Brown opened a law office July 1st of 2010. At the end of that first month, the balance sheet showed cash of 5,000, accounts receivable of 1,500, supplies of 500, and office equipment of 6,000. We had liabilities, accounts payable of 4,200, and capital account had 8,800. That was the end of July. Now we have transactions for the month of August. Our job is going to be to prepare an analysis of these transactions, beginning with the July 31st balances. We are going to set up a little tabular look. We're going to see how these transactions, we can visually see how they impact the accounting equation. Here are our assets: cash, accounts receivable, supplies, and office equipment. Total assets equal liabilities, notes payable and accounts payable, plus owner's equity, owner investments in the capital account, less owner drawings, plus revenues, and minus expenses, or here is our net income. Okay. First thing we're going to need to do is set up the beginning balances for August, which were July's ending balances. So I'm going to carry these balances right into our table here. So here's our beginning balance in cash of $5,000, accounts receivable of $1,500, supplies of $500, office equipment of $6,000, accounts payable of $4,200, and capital of $8,800. Okay, if I were to add these up, my total asset account balances equal my total liabilities and equity account balances. Now let's see the impact of these transactions that occurred during the month of August. First thing, collected $1,200 of accounts receivable. If we collected amounts owed to the company, that means our cash must have increased and our accounts receivable must have decreased. Bringing our cash balance up to $6,200 and our accounts receivable balance down to $300. Supplies, equipment, accounts payable, and owner capital balances did not change. If I were to add these up, our accounting equation is still in balance. The next thing that happened is $2,800 of cash was paid on accounts payable. Cash was paid, cash decreased $2,800, so we're going to decrease cash. If we paid off liabilities, our liabilities also decreased. Paying cash down to $3,400 and liability balance down to $1,400. If I were to add up my total assets, they would still equal my total liabilities and owner's equity. Next thing, earned revenue of $8,000. $3,000 of it is collected in cash. The balance is due in September. Cash increased $3,000. The rest of the $5,000 is going to be paid later. That means our accounts receivable increased. So we're increasing cash for the cash received, increasing accounts receivable, and revenues were earned, so we are increasing our revenues. Here are our new balances after those transactions were recorded. Purchased more equipment on account. Purchased more equipment for $2,000, paid $400 cash, and the rest on account. So if we bought equipment, we now have an increase to our equipment. Our equipment increased, our asset increased. Part of the payment was made in cash, $400, decreasing cash $400. The remainder reflects an increase to our liabilities because we still owe $1,600. Taking into account the change, we now have new account balances. If I add up my assets, we still equal my total liabilities and equity. We paid salaries of $2,500, rent for August of $900, advertising expenses of $400. We made payment for 3 different types of expenses. If we paid, that means our cash went down $2,500, $900, and $400. Total cash went down $3,800, and our expenses increased. We have $2,500 salary expense, a $900 rent expense, and a $400 advertising expense. Now notice these minus signs here are a little misleading. These minus signs make you think that expenses are decreasing. We are recording expenses being incurred. So these are increasing the balance in these expense accounts. The reason the publisher puts a minus sign here is to show that as these expenses are increasing, we increased expenses a total of $3,800, they are causing overall equity to decrease because as expenses go up, equity goes down. Okay, so that's the reason for that minus there. We now have our ending balances after that transaction. Assets equal liabilities plus owner's equity. We withdrew, or the owner withdrew $700 in cash for personal use. The owner's taking cash out of the business, decreasing the cash asset account, and the owner is taking profits out of the company, we are going to increase the owner's drawings account. As the owner drawings account balance increases, it causes overall equity to go down. Just like expenses, that minus sign doesn't mean that drawings are decreased. That means that we increase the balance to $700 in the drawings account, which causes overall equity to decrease, and that's the reason for that minus sign. We received $1,500 from Standard Federal Bank, money that we borrowed on a note payable. We borrowed cash from the bank. If we borrowed cash from the bank, our cash asset is increasing $1,500. If we borrowed money, we now have an increase to our liabilities. Our notes payable are going up. Liabilities are going up to $1,500. Again, adding up all the account balances, the equation's still in balance. Finally, we incurred utility expenses for the month on account of $220. We incurred expenses, we haven't paid them. We are going to record an increase to our accounts payable liability, showing that we now have more liabilities to pay. We are going to record another $220 into our expenses. Notice our expense account balance is increasing. Again, I'm sure you remember, because expense is increasing cause equity to go down, that's why we're seeing the minus. Expenses went up, causing equity to go down more. Total assets, $16,800 equal total liability account, equity account balances of $16,800. It is now the end of August. The problem wants us to now prepare an income statement, owner's equity statement, and a balance sheet. As we've been going through this month, we've been recording the impact of these business transactions on these accounts. Owner wants to know how we're doing at the end of this August month of operations. We're going to prepare reports to communicate to her. The very first report we prepare, we always prepare the income statement first. So here is our income statement. Revenues earned for the month were $8,000, which we saw down here. Total revenues earned that we recorded in the account were $8,000. And out of all of our expenses, going back and looking at the detail, here are the expenses. Revenues minus our expenses gives us net income during the month of $39.80. Revenues exceeded expenses. The second statement we prepare is the owner's equity statement. It reports the change in the owner's equity from the beginning of the month or the period to the end of the period. Looking down here at our accounts, we know that the owner started the month with $8,800 in the capital account. She had withdrawn $700 during the month. If we began with $8,800 in owner's capital, net income, which comes from the income statement, less the owner's drawings, ending capital at the end of the month with $12,080. Owner's equity increased to $12,080 as a result of income less the drawings. Finally, the last financial statement we prepare is the balance sheet, and the balance sheet reports the financial position on one day in time. Notice the difference in the date between the balance sheet and the owner's equity and income statement. Those two statements are reporting things that happened over a period of time, but the balance sheet is reporting the financial position on the last day of the accounting period. I'm going to take all of the ending balances in my cash account, all of my assets, my liabilities, and my ending equity. My ending equity balance comes from my statement of owner's equity, $12,080. Here are my total assets of $16,800, my total liabilities of $47,20, and my ending capital of $12,080. Total liabilities and owner's equity equal the total assets. Let me know if you have any questions on any of these problems.